Okay, very good morning to everyone, and a happy Friday, 19th of May. Let's get the briefing underway. And first off, just looking at where the US finished yesterday, in terms of the closing prices, the S&P up just shy of 0.4%, the Nasdaq up 0.8%, the Dow up 0.27%. So if you were turning the clocks back just about 24 hours ago, we were talking in a briefing about the Nasdaq sharply underperforming, the fact that the tech stocks kind of have more room for a correction given how far and to what extent that they've rallied post-Trump on this premise of the corporate tax cuts and so on. Financials the same. Well, yesterday you had the opposite reaction, and the Nasdaq saw some outperformance, and we had a pretty broad recovery on Wall Street to finish in some, generally speaking, firm positive territory. Just looking at the S&P here, what you had yesterday was, if you remember, through the European morning, in what otherwise usually is a fairly quiet period of the session for UK and European markets, but going through that period between 10 AM and midday, typically that's when the calendar for the morning is done. That's actually when we started to see a bit of a pickup and this risk aversion kind of trend materializing again in Thursday morning session. The breach of the previous day's lows that came very late, just before the Wall Street closed, before a slight recovery that was seen overnight in Asia, likely as well just prompting a bit of a further extension of those losses. And it really took until the US came in. Really, if you look at the candlesticks here, it's the open on Wall Street, the market recovered some, and then further into the final kind of portion of the US session, and it's kind of just sat there, pretty confined price action, sitting just above pivot in the overnight Asia Pac session. So a bit of a recovery, as per kind of one of the things I was talking about in the strategy yesterday, is that there's obviously been a knee-jerk reaction to Trump. It's kind of the fact that we've had multiple developments on a story in regards to the Russian relationship and the Trump administration certainly caused the VIX, which had been trading, that kind of fear gauge or volatility index, which was tracking at its lowest since 1993. It was kind of ripe for a sharp pickup, and that certainly did occur midweek. But ultimately, time frame wise that it will take for this investigation to be more thoroughly done, most expectations are that Trump is not going to really come under pressure in that regard from Congress until really July. So getting to a point of where we've got more clarity other than media speculation, this isn't going to happen anytime in a kind of an immediate fashion. Therefore, you've had a bit of a recovery. The market's kind of got over that initial sentiment that saw that fairly substantial sell-off midweek. The yen as well then has also bounced. We're back up to around 111.30, having got very close to 110 only yesterday. One of the bigger headlines that came out and probably assisted some of the recovery was this one. And obviously Comey is what really, when all this began, this whole story, and that was when Trump surprisingly fired the FBI director. Really with, at the time, no rhyme or reason, but then obviously he was the man who was investigating the president over the potential involvement of Russia in the run-up to the election, and this is what's led to these stories we've seen this week. One of the interesting things that came out last night was this headline: Comey admits under oath that obstructions to investigations never happened. I'll put this link into the chat afterwards, and it's actually got the actual video feed from a testimony that was given on oath in front of the Senate on the 3rd of May. This was before he was fired, and Comey states quite explicitly that he had not been pressured to close an investigation for political purposes. It had not happened in his experience. And so obviously this is another twist in the tale, more in favour of Trump. But I guess anything for the market, this kind of lessens the impact, let's say, and credibility over the situation, and certainly what some of the angle has been about Comey. So that probably helped as well alleviate some of those near-term concerns. That didn't come out until a bit later, but that certainly did come around the time that you had that second little flush higher in the US equity market. That was when that comment came out and those reports started to circulate. So it certainly helped add to some of the bounce that was seen after the Wall Street Open. Okay, the other big kind of move overnight, I guess, because there hasn't really been a great deal of news other than the one just discussed, has been in sterling. Now, when you come in, you'll probably look at your chart and think, what on earth happened at about 6:30 last night? Well, let me just have a look at what this chart looks like, not on a 1 minute, but a 1 second chart. This is actually the time frame for London time is an hour on this bottom axis time frame. So this is looking at 1 second movements within cable. And what you're looking at here is basically a 12-second move that occurred and saw a drop. Well, we're looking from around, really, in the futures, the 130 handle down to 129 as a full point move or 100 pips. Now, the thing about this is there is no news. There was no fundamental reason. The actual headline concerning Comey that we just said didn't come for about another 20-30 minutes after this move had occurred. This then looks to be just another case of the kind of changing dynamic of financial markets being ever more driven by algorithmic trading. And if you remember, if we look back at the cable chart, let's put this in a bit of context. This was a previous chart I had marked up from some other talks that I've given. But one of the bigger areas here, if I put a rectangle on just to highlight it, was this particular candle there. If you can see that right in the middle of that chart. That was on, I believe it was October 7th. Yeah, that was golden, I think it was Golden Week, or as a Chinese holiday. Chinese markets were definitely closed, and at 7 minutes past midnight, that was a Sunday, I remember, very illiquid conditions, and essentially an algo triggered another algo to fire off, and then we saw a spike. But putting into context, last night we spiked 100 pips. On October the 7th, we spiked 600. So let's not get last night's, let's put it in a bit of context. The flash crash that happened on October 7th was 600 pips. Last night's was a paltry 100. Doesn't really change the fact that certainly the propensity for these types of moves to happen certainly is growing in regularity. And at this point, I would say financial regulation for automated trading is particularly loose. The technology advancements that a lot of firms are putting into this type of technology is outpacing that of the regulatory environment. The regulatory environment is still catching up really from post-financial crisis. And so these things, as banks invest more money into this tech, are undoubtedly becoming a more regular occurrence. The reason why the previous one was so much larger was because of the conditions. It would have been far more illiquid at that particular point. That was right overnight on a Sunday night with China out of the market, so probably near on zero liquidity. Whereas last night, what you had was around 6:30 or 6:35 in the evening. There still would have been market participants there. What often happens then, when you're looking at the price action this morning, when you've had essentially a move that's happened without a fundamental reason, is you get a natural retracement of that price back to exactly where it was. So net, you go back to neutral, Xing out the move, which is down to kind of non-related reasons, other than probably a few orders going through, another momentum kind of system picks up on that, it hits it, flushes out a few stops, the move then kind of gathers momentum pretty quickly. Obviously there's been some other things that you could argue sterling wise. Labour have been making some ground in the polls of late, particularly this week since they unveiled their manifesto. kind of the social media movement in favour of Labour, the disappointment that the markets had with the Tory manifesto released yesterday hasn't been kind of met particularly positively. You've also had the Brexit minister David Davis talking pretty aggressively about we either have a deal or no deal. That's all fine and kind of fits the move, but I don't think that's why this occurred yesterday. This is simply a byproduct of just market function of automated trades going through and causing a minor flash crash at the time. So I think net, I wouldn't read too much into that price point, because if you look at where we're trading at the moment, we're pretty much exactly where we were really for the consolidation of the large part of where we were trading about 2 days ago. Obviously the pop higher that we have had yesterday did breach in cable a very significant level. If I just put my charts over slightly, you had that strong resistance level of 130 broken yesterday. That came, of course, amid the retail sales number. A lot of people probably heading into that were expecting a bit of a seasonal boost with April readings containing the Easter effect, but they far exceeded expectations. And there were upward revisions to the previous data, of which, if you remember, was much weaker than expected at the time it came out last month. So a kind of dual-fold positive release saw cable further move higher, exacerbated by the technical break of that key level, and we shot up. We did retrace that, but we're looking where we are at the moment. I'd still say keeping an eye on that 130 in the futures. We're only about 10 pips away from there at the moment. We'll continue to be watched quite closely by the market, I'd say. And then defining any move above there would be yesterday's high print at 59. Really, it still comes down to, I'd say, more dollar dynamic than it does anything to do with the euro and the pound to some extent. It's really the dollar that's been driving things, this Trump stories being the main focal point of market direction across asset. And I'd still expect that to really be the case today, barring anything unexpected coming out specifically on Brexit talks and things like that. Quick look at some other things in the press this morning. You have had German producer prices this morning, and I point them out just because prices faced by German manufacturers have climbed to their highest in nearly 6 years as inflation on the march across the continent. Obviously, the fears of inflation in the Eurozone, as well as really globally, aside from the UK, which has blipped up, we know, to the highest since September 2013, earlier this week. Eurozone inflation's petered off slightly to alleviate some of those concerns that it was going to shoot higher and cause the central bank to bring forward their kind of tightening communication. That has taken a bit of a backseat. Most of the ECB members, I'd say the market consensus on the ECB starting to lay the first hints towards a policy change isn't expected until June. But producer prices in Germany are still rising. As you can see here, this is looking back from the summer of last year, so this last portion of the chart on the right hand side is the last year or 12 months, and certainly it's been a very rapid rise and one to continue to monitor. I'm sure this will keep the likes of the more hawkish minded Bundesbank and Jens Weidmann sitting still on the argument that the ECB need to start thinking about coming out of the more accommodative policies that have been in place. Other things are, I was looking at oil stories this morning. This isn't particularly new. OPEC expected to prolong curbs to ease global glut at the Vienna meeting. Remember, it's next week we get the Vienna meeting. That will kick off on the 25th, so that's next Thursday. There was a Bloomberg survey overnight. All but one analyst sees OPEC extending output cuts. I think that's pretty much baked in as the market expectation. Quite an interesting just graphic here. It's looking at the OPEC production. So remember, it's November 30th. This is when they were tracking at record output at that point in time. We've then seen a sharp fall in crude production from OPEC nations as they adhere with high compliance to the agreed quotas. But at the same time, look at US output and how steep the incline has been since the beginning of November, which of course was when Trump won the US election. It has been one of the most aggressive rises that we've seen, and US output currently is tracking at its highest since April of 2015 at the moment. So this continues to diverge, if you like, in direction. It's something which will probably continue to be the case, but looking at the markets this morning, this is kind of the broader context. We've managed to squeeze a little higher as the week's gone on, and if you look where we are at the moment, the commitment, I would say, is the week as a whole. These are daily continuations, so if we go back to what would have been the beginning of the week, would have been here. We were at the 48 handle, so OPEC have managed to get another $2 out of this move, but we were tracking on those lows. Sub 44 was on the 5th of May. So it wasn't that long ago at all, only about 11 days ago. And if you look at where we were to where we are currently, crude oil has risen 14%, quite on the slide, so to speak. Everyone puts a lot of emphasis on oil. It draws attention when it's falling because it then prompts a number of oil producing nations to comment. When it starts rising, you almost get the opposite. And certainly this last commitment we've heard from specifically Saudi Arabia and Russia, that not only do they want to extend by 6 months, they're now talking and have said they're happy to do 9 months. Although we talked about this earlier this week, that has complication over maintaining such a high level of compliance the longer the deal goes on. It certainly has been enough, at least for the time being, for oil to reclaim close to the $50 handle. One of the important things as well from a US output point of view, and as defined by this chart here, is actually US output in the last Department of Energy inventory data on Wednesday did show a minor, very minor, but important because it went down, was US output by percentage. I think it was something like just under 0.01% or something of that magnitude, or 0.1%. So very small, but does go against what had been at some points nearly 1% rises week to week in output. Okay, quick look at the calendar for today. It is fairly quiet. There's not too much on the docket for this morning, certainly. So as we were just looking at the charts, I'd probably still be interested to just monitor cable at that 130 level. The DAX really not doing a great deal this morning at the moment. We're kind of sitting there around yesterday's high, comes in at 12,641.5. Might be worth watching as we're sitting just off that at the moment. Going into the afternoon, you've got Canadian data, so this is actually potentially interesting if you are trading the CAD. So for any of the live guys in the trading live room, retail sales CPI numbers coming out, and then this afternoon you've got the EU consumer confidence flash reading, ECRI data, Baker Hughes. So fairly light on the calendar. I would therefore be still monitoring risk assets like the yen, like gold. Any commentary specifically from more higher ranking Republican officials will be key. But quite honestly, I think that for this week at least, the negativity has subsided now. Very important that we had was the speech, I think it was on Wednesday, when we were right in the midst of this Washington Post, New York Times story about Trump. It was very telling that the House Speaker Paul Ryan was basically sticking up for Trump, as to have so far the other officials on the Republican side, irrespective of Democratic politicians calling for impeachment. And so that's managed to negate, at least for the time being, that negative sentiment. And I would expect that probably to continue, the exception being if there was any new material that was to come to light. So tracking sentiment, looking for the US to really take the lead, and any developments pertaining to the political situation on Trump is what I would be looking out for today. Trump tweets, obviously, as well, something to be monitoring. Just to recap, he tends to, London time, tweet between kind of 11 a.m. to 12 is kind of the hot zone, if you like, for potential tweetage from Trump. Looking at the speakers for today, just to round up the calendar, this is the one part, although economic data is fairly quiet, speakers could be more interesting. You've got ECB's Praet speaking at 10, Coer 12, Constancio, who's kind of the second in command, if you like, at the ECB, speaking at 1 o'clock. And then you've got Fed's Bullard giving a press briefing as well at 2:15, so worth keeping an eye on these. From an ECB perspective, given the context, obviously, that euro dollar is still trading a 111 handle, it'll be interesting to see if the ECB will remain kind of neutral, leaning more hawkish, setting the ground for this subtle change to being more hawkish in the summer, or at the fear of pushing euro any higher, do they kind of ease off that slightly? So monitoring those comments could be quite interesting later. Philippe just asking me as well, just before I kind of wrap up the briefing, about there was some incidents that unfolded. I did see them last night where it looked at first instance a little bit similar to what we've seen in France and in Germany in regards to a vehicle was driving on the sidewalk in Times Square yesterday that injured multiple people. I believe there was also another incident that happened in Staten Island. As far as I was aware when I was monitoring that last night on Twitter, it was simply a drunk driver, nothing to do with terrorism. It didn't have any impact on the market at the time. I did check. So hopefully that answers your question, Philippe. Okay, guys. Gonna leave it at that. So enjoy the session, and I'll see you in the chat room. And if I don't speak to you before then, enjoy your weekend. Thank you.